Hello, I'm Christian Diebitsch. I manage the Heptagon European Focus Equity Fund. Here are my comments for November. November was the second best performing month in 2022. The fund was up by 8%, the market was up by 7%, so roughly 1 percentage points outperformance. When you look at the sector breakdown, every industry sector in Europe performed well, every sector was up. The best performing sector was consumer discretionary, it was up 14%, and the second best performing sector was up 10%. That's why the fund did quite well. So this means that in the year to date, Europe has fallen by 6% in the year to the end of November. There's only one industry sector which is positive, and that's energy. It's up by 40%, and that's a deep value sector. The second best performing sector is healthcare. It's down by -4%. The third best performing sector is financials. That's down by 5%. It's also deep value. And the fourth best performing sector is consumer staples, and that's down by 7%. So there's quite an anomaly here, because on the one hand you have two of the top four performing sectors which are deep value, that's energy and it's financials. And then you have two very defensive sectors, that is healthcare and consumer staples. And that means that the market is pretty much moving in a very volatile fashion. The European focus has roughly 28% in healthcare and 24% in consumer staples. So more than 50% of the exposures in the fund are to the two best performing sectors in which the strategy is actually allowed to invest. November was a realization for many investors in our view. What really happened was that the market figured out that most likely US inflation numbers have peaked, and that led to a sharp decline in long bond yields in the States. So when you look at the US 10-year yield, it fell from over 4% at the beginning of the month to around 3.6% by the end of November. And bond yields have continued lower in the early part of December as well. So with lower bond yields, of course, growth stocks did quite well. So for example, holdings in European focus like Zalando, ASML, Hermes, Straumann, Adyen, etc., they performed really well, and all of them generated double-digit returns. The key issue for us for 2023 is what sales and profits will do. So when we look at the two last reporting seasons, in the second quarter, what happened was that consensus estimates for profits were brought down because input costs were going up. But because inflationary pressures were quite high at the time, revenue forecasts went up. When you turn to the third quarter, what happened was that sales forecasts were still going up, but there were not much change to consensus estimates. So the market has actually been quite benign in that sense. Not much has happened to profit forecasts for the companies in our portfolio. Another positive takeaway, particularly in the first half for our portfolio holdings, is that many of the input costs have actually now started to level off. When you look at various kind of components, raw materials and transportation costs, they've all either leveled off or they've actually started to fall. The only real cost increase where we can see going higher in 2023 is wages and salaries. Then of course we have energy costs, and who knows really, I think it's too early to say. If there is some sort of negotiated peace between Russia and Ukraine, of course the oil price will fall, and that should be good news. But on the other side of the coin, what's going to happen to China? China is opening up, of course demand will increase, and if China requires more oil, that puts pressure on the oil's price going up. So as far as energy is concerned, I think we just have to wait and see. Sadly for us Europeans, I think we're pretty much in the hands of the Americans. The S&P 500 typically starts to discount recovery in US GDP growth 2 to 4 quarters before it becomes visible in the numbers. When you look at European stocks and European GDP growth, there's virtually no correlation between the two. And that is so because Europe is an export-dependent region. So that's what I'm saying. I think it's really dependent on what actually happens in the US, and it's really in the hands of the Fed. And the Fed, as I pointed out in some of the previous monthly comments, it has two aims as far as inflation is concerned. One is to bring down the absolute inflation number to around 2%, and the second is to reduce inflation expectations. So we really have to see bond yields come off. It has started somewhat in the fourth quarter, but I hope that as we go through 2023, there will be, shall we say, lower inflationary pressures feeding through and lower inflation expectations. But we'll just have to wait and see over the next few months. So these are my sort of formal comments for about the fund and the market for November. We've also been running a short 12 days of European focus in the run up to Christmas. The clips and the commentaries are less than 1 minute. It's essentially a different theme every day, an introduction to the fund. There's some companies that we're commenting on, like Diageo, like Lindt & Sprüngli, like Novo Nordisk. We're also commenting on the beauty of compounding and some of the ESG related stuff. So I would urge you to tune in and look at what we have to say there.